You are listening to the CMQ Investing Podcast. My name is Chris Franco, and we have to talk about Bitcoin. And just generally what's going on in the crypto space right now is coins that people have been told will be the path to financial freedom are pretty much going down like a boat full of lead that has a hole in it. I'm not reveling in that. I'm not celebrating anyone losing money. We never do that here. But I do want to talk about the bigger issues at hand. What might be causing this? Where do I think it's going to go next? And are there any lessons we can learn from people like Warren Buffett and Charlie Munger that might be applicable to other things like this that we'll be presented with in our investment lifetimes? As I sit here right now and talk to you, the price of Bitcoin is hovering around $22,000. I made some videos on our YouTube channel, CMQ Investing on YouTube, where someone was, I think she's the head of the Digital Chamber of Commerce, which was like something that was made up within the last 5 years, I think. But they were saying, they're buying now. Everyone's been saying, this is the opportunity now, and it's only gone down since, which is, again, no one knows. And when you're dealing with something like Bitcoin, which is down 45% in the last year, 25% in the last month, 27% in the last week, and actually 5% just today, you don't know what's going to happen. And as I've said before, and I've tried to be very consistently warning our audience about, is there's nothing underneath this. It fundamentally, people say things like, oh, there's no intrinsic value. And I think sometimes those words and that kind of language, it doesn't resonate with people, right? Because not everyone investing in Bitcoin is going to be, nerding out over Warren Buffett and Charlie Munger and Jack Bogle and other legendary investors. That's totally understandable. Bitcoin has been marketed extremely well to, the everyday investor as something that, you have to have some of because it's going to go to the moon. And, as if it's the blue chip of crypto assets. And there's also this tendency, I think, where some of the pumpers of Bitcoin will use language that's very similar or exactly the same as language that's used for productive assets like stocks, but use it for something that's not a productive asset like Bitcoin. We're talking about things like market cap and the intrinsic value, and as I mentioned a second ago, and I could go down the list, even that mention of blue chips. Now, what I want to share with you is a letter that Warren Buffett wrote to shareholders in 2011, and he specifically discusses the three types of assets, and he provides a sort of context that I think will provide a lot of clarity about what's going on right now with not just the Bitcoin crash or the crypto crash, but also just generally speaking, inflation and a lot of the volatility that is making investors understandably very uncomfortable. So as I've said before, if you've listened to the CMQ Investing Podcast, you know that I find so much value in just randomly opening up the Berkshire letters from over the years. I mean, there's just so much wisdom. It's easy to understand, and it really does help me tune out the noise, which is, I think, one of the most important things that we're able to do as investors. So without further ado, let me read this to you. As I said, it comes from the 2011 letter to shareholders. The words are from Mr. Warren Buffett himself. The wisdom, I believe, is enduring, and I think you'll see a lot of parallels to what's going on right now. If you haven't subscribed yet, please do that. Much appreciated. Let's get to it. Investments that are denominated in a given currency include money market funds, bonds, mortgages, bank deposits, and other instruments. Most of these currency-based investments are thought of as safe. In truth, they're among the most dangerous of assets. Their beta may be zero, but their risk is huge. Over the past century, these instruments have destroyed the purchasing power of investors in many countries, even as the holders continue to receive timely payments of interest and principal. This ugly result, moreover, will forever recur. Governments determine the ultimate value of money, and systemic forces will sometimes cause them to gravitate to policies that produce inflation. From time to time, such policies spin out of control. Even in the U.S., where the wish for a stable currency is strong, the dollar has fallen a staggering 86% in value since 1965, when I took over management of Berkshire. It takes no less than $7 today to buy what $1 did at that time. Consequently, a tax-free institution would have needed 4.3% interest annually from bond investments over that period to simply maintain its purchasing power. Its managers would have been kidding themselves if they thought of any portion of that interest as income. For tax-paying investors like you and me, the picture has been far worse. During the same 47-year period, continuous rolling of U.S. Treasury bills produced 5.7% annually. That sounds satisfactory, But if an individual investor paid personal income taxes at a rate averaging 25%, this 5.7% return would have yielded nothing in the way of real income. This investor's visible income tax would have stripped him of 1.4 points of the stated yield, and the invisible inflation tax would have devoured the remaining 4.3 points. It's noteworthy that the implicit inflation tax was more than triple the explicit income tax that our investor probably thought of as his main burden. In God we trust may be imprinted on our currency, but the hand that activates our government's printing press has been all too human. That is an awesome line. High interest rates, of course, can compensate purchasers for the inflation risk they face with currency-based investments. And indeed, rates in the early 1980s did that job nicely. Current rates, however, do not come close to offsetting the purchasing power risk that investors assume. Right now, bonds should come with a warning label. Under today's conditions, therefore, I do not like the currency-based investments. Even so, Berkshire holds significant amounts of them, primarily of the short-term variety. At Berkshire, the need for ample liquidity occupies center stage and will never be slighted, however inadequate rates may be. Accommodating this need, we primarily hold U.S. Treasury bills, the only investment that can be counted on for liquidity under the most chaotic of economic conditions. Our working level for liquidity is $20 billion. $10 billion is our absolute minimum. Beyond the requirements that liquidity and regulators impose on us, we will purchase currency-related securities only if they offer the possibility of unusual gain, either because a particular credit is mispriced, as can occur in periodic junk bond debacles, or because rates rise to a level that offers the possibility of realizing substantial capital gains on high-grade bonds when rates fall. Though we've exploited both opportunities in the past, and may do so again, we are now 180 degrees removed from such prospects. Today, a wry comment that Wall Streeter Shelby Colum Davis made long ago seems apt. Quote, bonds promoted as offering risk-free returns are now priced to deliver return-free risk. We'll say that again. Bonds promoted as offering risk-free returns are now priced to deliver return-free risk. Okay, now to the second major category. The second major category of investments involves assets that will never produce anything, but that are purchased in the buyer's hope that someone else, who also knows that the assets will be forever unproductive, will pay more for them in the future. Tulips, of all things, briefly became the favorite of such buyers in the 17th century. This type of investment requires an expanding pool of buyers, who in turn are enticed because they believe the buying pool will expand still further. Owners are not inspired by what the asset itself can produce. It will remain lifeless forever, but rather by the belief that others will desire it even more avidly in the future. The major asset in this category is gold, currently a huge favorite of investors who fear almost all other assets, especially paper money, of whose value, as noted, they are right to be fearful. Gold, however, has two significant shortcomings, being neither of much use nor procreative. True, gold has some industrial and decorative utility, but the demand for these purposes is both limited and incapable of soaking up new production. Meanwhile, if you own 1 ounce of gold for an eternity, you will still own 1 ounce at its end. What motivates most gold purchasers is their belief that the ranks of the fearful will grow. During the past decade, that belief has proved correct. Beyond that, the rising price has on its own generated additional buying enthusiasm, attracting purchasers who see the rise as validating an investment thesis. As bandwagon investors join the party, they create their own truth for a while. Now, this obviously sounds exactly like what we've been experiencing over the last few years with Bitcoin, but let me continue. Over the past 15 years, both internet stocks and houses have demonstrated the extraordinary excesses that can be created by combining an initially sensible thesis with well-publicized rising prices. In these bubbles, an army of originally skeptical investors succumbed to the proof delivered by the market, and the pool of buyers, for a time, expanded sufficiently to keep the bandwagon rolling. But bubbles blown large enough inevitably pop, and then the old proverb is confirmed once again. What the wise man does in the beginning, the fool does in the end. Today, the world's gold stock is about 170,000 metric tons. If all of this gold were melded together, it would form a cube of about 68 feet per slide. Then Buffett says, picture it fitting comfortably within a baseball infield. At $1,750 per ounce, gold's price as I write this, its value would be $9.6 trillion. Call this cube Pile A. Let's now create a pile B costing an equal amount. For that, we could buy all U.S. cropland, 400 million acres with output of about $200 billion annually, plus 16 ExxonMobils, which is the world's most profitable company, one earning more than $40 billion annually. After these purchases, we would have about $1 trillion left over for walking around money. No sense feeling strapped after this buying binge. Can you imagine an investor with $9.6 trillion selecting pile A over pile B? Beyond the staggering valuation given the existing stock of gold, current prices make today's annual production of gold command about $160 billion. Buyers, whether jewelry and industrial users, frightened individuals, or speculators, must continually absorb this additional supply to merely maintain an equilibrium at present prices. A century from now, the 400 million acres of farmland will have produced staggering amounts of corn, wheat, cotton, and other crops, and will continue to produce that valuable bounty, whatever the currency may be. ExxonMobil will probably have delivered trillions of dollars in dividends to its owners and will also hold assets worth many more trillions. And remember, you get 16 Exxons. The 170,000 tons of gold will be unchanged in size and still incapable of producing anything. You can fondle the cube, but it will not respond. Admittedly, when people a century from now are fearful, it's likely many will still rush to gold. I'm confident, however, that the $9.6 trillion current valuation of Pile A will compound over the century at a rate far inferior to that achieved by Pile B. Our first two categories enjoy maximum popularity at peaks of fear. Terror over economic collapse drives individuals to currency-based assets, most particularly U.S. obligations, and fear of currency collapse fosters movement to sterile assets such as gold. We heard cash is king in late 2008, just when cash should have been deployed rather than held. Similarly, we heard cash is trash in the early 1980s, just when fixed dollar investments were at their most attractive level in memory. On those occasions, investors who required a supportive crowd paid dearly for that comfort. My own preference, and you knew this was coming, is our third category, investment in productive assets, whether businesses, farms, or real estate. Ideally, these assets should have the ability in inflationary times to deliver output that will retain its purchasing power while requiring a minimum of new capital investment. Farms, real estate, and many businesses such as Coca-Cola, IBM, and our See's Candy meet that double-barreled test. Certain other companies, think of our regulated utilities for example, fail it because inflation places heavy capital requirements on them. To earn more, their owners must invest more. Even so, these investments will remain superior to non-productive or currency-based assets. Whether the currency a century from now is based on gold, seashells, shark teeth, or a piece of paper, as today, people will be willing to exchange a couple of minutes of their daily labor for a Coca-Cola or some See's peanut brittle. In the future, the U.S. population will move more goods, consume more food, and require more living space than it does now. People will forever exchange what they produce for what others produce. Our country's businesses will continue to efficiently deliver goods and services wanted by our citizens. Metaphorically, these commercial cows will live for centuries and give ever greater quantities of milk to boot. Their value will be determined not by the medium of exchange, but rather by their capacity to deliver milk. Proceeds from the sale of the milk will compound for the owners of the cows, just as they did during the 20th century when the Dow increased from 66 to 11,497, and paid loads of dividends as well. Berkshire's goal will be to increase its ownership of first-class businesses. Our first choice will be to own them in their entirety, but we will also be owners by way of holding sizable amounts of marketable stocks. I believe that over any extended period of time, this category of investing will prove to be the runaway winner among the three we've examined. More important, it will be by far the safest. Thanks so much for listening to this episode of the CMQ Investing Podcast. I hope you'll subscribe, tell a friend, give us a 5-star rating, and leave a nice review, assuming that you have nice things to say. For CMQ Investing, my name is Chris Franco. Thanks again for listening, and we'll talk soon.